Deriving the Black-Scholes-Merton equation using Ito's lemma. The goal of this video is to derive the Black-Scholes-Merton equation and to make sense of this model. This equation is extensively used in pricing call and put options in finance. Okay, before we start, there are some prerequisites. In the previous video, we discussed Ito processes and derived Ito's lemma from scratch. Please have a look at that if you are not familiar with these topics. But very briefly, an Ito process is a general drift diffusion process. The uncertainty here arises due to dW, which represents a Wiener process. It's a product of square root of dt and epsilon that is sampled from a standard normal distribution. And Ito's lemma is essentially a total derivative expression of a function that depends on this Ito process and also time. Then we can think of df itself as a stochastic process with these non-constant drift and diffusion coefficients. Alright, now to start deriving the Black-Scholes-Merton equation, we first need to have a model for how the stock prices move. A simple and naive way is to assume that the change in stock prices has a constant drift mu and constant volatility sigma. So mu here would be the mean earnings of a stock. Now, this is actually a bad model. To see that, let's think of the percentage changes, so divide the whole thing by S. What this tells us is that as the stock price grows, the mean percentage return will drop. But that's not very realistic, as the shareholders will expect similar percentage returns even as the stock price grows. Or for example, think of two separate stocks in the same industry, say computer chip production. One has a stock price of $10 and the other is $20. For the sake of argument, let's say that they both produce very high quality chips. So the business fundamentals are the same for these two companies. That means one can expect to have the same percentage returns for these two stocks. Just because one has a larger stock price should not mean that it will have a lower return as suggested by the above model. So that's why this is not a good model. To fix that, we will simply multiply the drift and diffusion terms by S. This is a better model, and it's also known as geometric Brownian motion. Now you will see that the drift and diffusion coefficients stay constant as the stock price changes. Once again, here mu is the expected return of the stock per year, and sigma is the volatility of the stock price per year. This new model is important. This is the assumption that gives the stock prices their log normal property. It also tells us that this ratio is going to be normal. That's because we know that dW is normal by definition, and the sum of normal random variables is going to be another normal variable. Alright, where do we go from here? Now we need to use this model to construct a riskless portfolio. This is what Merton did in his derivation of the equation. The portfolio is as follows. 1. We have a long 1 unit of the derivative f, and 2. We short a delta is equal to del f over del s units of the underlying stock. So our portfolio P is equal to positive f minus delta s. The signs can be tricky here. In this portfolio, we have one long of the option, which means we own the option. In other words, it is an asset to us, so we put a positive sign in front of it. Next, we said that we shorted delta units of the stocks. This means that we have borrowed delta units of stocks and then sold it at the market. So we don't actually own these stocks and need to deliver them back at some point in the future. In other words, this is a liability and we need to put a negative sign in front of it. By the way, you might wonder why are we choosing this kind of portfolio, but you will see the reason soon. Next, let's write the infinitesimal change in this portfolio. Now we're going to use the model we discussed previously, and also we're going to use Ito's lemma. Here, note that x is going to be s because that's the underlying Ito process here with a drift of a is equal to mu s and diffusion of b is equal to sigma s. So let's substitute df and ds into our portfolio change. So this term will cancel with this, and this term will cancel with that term. Overall, we are left with an expression that only has a drift dt term, but no diffusion term with dw. So if we don't have dw, there is no stochasticity or uncertainty. Namely, this is a risk-free portfolio. The reason this is even possible is because both the option and the underlying stock depend on the same uncertainty dw that appears in our geometric Brownian motion model for our stock. So now we see that this portfolio was judiciously carefully chosen to cancel out those dw terms. Okay, now that we showed that this portfolio is risk-free, we argue that the return of this portfolio should be just the risk-free rate R. If that's not the case, there would be arbitrage opportunities. If it returns more than R, then one can borrow P amount of cash at rate R and invest in P for greater returns. If it returns less than R, then one can short sell P and lend the proceeds at R for greater profit. Okay, so now we just substitute the dP and P into this equation. The dTs will cancel out and we get this equation. This is known as the Black-Scholes-Merton equation for pricing options. Sometimes it's also written in terms of the Greeks. So this is the time decay theta. This is the delta, namely how the option price changes as the underlying stock price changes. And this is gamma, which is how the delta changes as the stock price changes, or just the second derivative of f with respect to s. Let me mention a few last things. This delta in our portfolio is actually not constant, but a function of time. So if you want to keep a portfolio risk-free, you have to be constantly rebalancing your portfolio. But for the purposes of deriving this partial differential equation, we don't really care about that. All we need is that the portfolio is risk-free for an infinitesimal amount of time dt. Also note that the drift term mu of the stocks is nowhere to be seen in the final expression. That's because of the way we delta hedged our portfolio, which led to cancelling out of mu. At the end, what remains of the stock model is the volatility sigma, which can be estimated in a few ways, but that would be out of the scope for this video. Another important point to remember is that the Black-Scholes-Merton equation represents a model, and so it will have limitations. Remember the model we built for stocks. Although it's a good model, the stock might move quite differently in reality. Also, the equation has assumptions. For example, when we build our portfolio, we short some stocks without any fees. But in reality, borrowing stocks might have associated fees. And we haven't even considered transaction costs or taxes. So overall, the model is very powerful and it's used extensively in options pricing. It had such a big impact on options trading that Scholes and Merton were awarded the Nobel Prize in Economics in 1997. Nevertheless, we have to keep in mind that the model has certain assumptions and therefore limitations in its applicability.